I think we're going rocking and rolling here. How's everybody doing? We missed last week, so it's been a couple of weeks since we've been in here playing with our portfolio. But very excited and anxious to get started and get back into the swing of things. We took a little bit of time off. Took last week off as everybody was mourning the fate of several popular figures around the country. Not going to go into it in great detail, but some of my staff members at Pitt News Magazine were very distraught. And so I just gave them the week off. And so we took the whole week off. Now, one of the problems that we have when we do that kind of thing is that we don't have any way to communicate that out to our trading community. And so some guys were sending me text messages. Lan, are you okay? I'm wondering if you're in the hospital. You all right? You make things. How come you missing your class? If we take a week off, and that was kind of impromptu. If I'm going to take time off, I generally say so the week before, or the day before, or the few days before in the class. But that was kind of impromptu, and we just decided to take the week off and let everybody take a break and do their thing, other than chase dollar bills. All right, and so felt like it wasn't appropriate to be chasing dollar bills last week, so we didn't chase dollar bills last week. So that's what we did, and I just had no way to tell everybody. I think what I want to do is I want to create a community, and I always tell everybody, I'm like, I don't. This isn't how I make money. I mean, I'm not here to make money. I don't care if you guys come. I mean, I do. I care if people come and show up. I wouldn't be doing this if I didn't care. I care a lot, but I mean, I'm not making money from you coming. My little community is so small here on YouTube. It's like, oh, well, you make money on YouTube advertising. Yeah. You know how much money they pay me? About $100 every 3 months. That's what I get paid from YouTube advertising. So it's not like I'm, getting rich doing this. And I just come and do it because it's fun. I like to do it. I like to share. I like to teach. It gives me meaning in life to do something. I need to create a community. So I oftentimes say, I don't want your email. I give you all my stuff for free. I mean, most of it. I do have stuff that I have some course material, of course, but I primarily teach at the university, and that's what I do. So this is the lab for the university. So I'm not out here peddling things. Now, I sold my software company, and we have started another software company, and we would invite you to come and join it, But it's, again, for me, it's not, I make more money trading than in my investments, and I can't think I could ever make, selling software again or anything like that. So I'm here mostly for fun. I think it's fun, and I would like to create a community. But I always tell everybody, I'm not here. I'm not asking you for your email. Here, you can just have this, or you can have that, or you can have all the PowerPoints. You can have all the slides. I don't care. I'm not here to build a big marketing funnel and get you guys to, send you emails all the time, hitting you up for stuff. But it would be nice to be able to communicate a little bit more closely. We do have the comments in YouTube, and that's about the best I can do. Now, YouTube does have some sort of a little community group thing that you can join. And a lot of guys, you'll see when you go there, it says, follow. So you hit follow, and then it'll say join. Then you hit join, and then they ask you for money. So the way you join is you join the group, and it asks you for money. Now, I'm not really going to ask for money, but I don't know if you can. I think you can join for free, but then I get a whole bunch of people from Pakistan and India, and not that those are bad countries, but they not generally people who are going to be trading in the community with us. So I want to keep those people out. And if you charge $1, they won't give you their dollar, so they won't join the. But for other people, I would say, well, $1 is more of a filter to try and keep out people who aren't serious, or $5 or something. So you can $5 a year or something, just so you want. But I'd like to tie it to Pitt News Magazine, because that's my baby. I love Pitt News Magazine, and I put that out, and I spend, my entire month working with my staff to create Pitt News Magazine. And so I would like to say something like, well, you're a member of the club if you have Pitt News Magazine, but then I'd have to send out emails. I don't want to be sending out emails to everybody. Well, I'm doing this, or I'm doing that, on an email. And then people start throwing the email in the trash. The only thing I want to go out into the Pitt News banner is, hey, here's the magazine. That's it. It's the only thing you should get from me on Pitt News Magazine is notifications and important things from Pitt News. I don't want to be sending out all kinds of other stuff through that email. So we need to create something else. Maybe I'll look into YouTube and see if there's not some way we can create a community in YouTube. so we can talk a little bit more freely to each other and stay in communication and that kind of stuff. But anyway, that's what I'm thinking. All right, we're here to day trade, so let's do a little day trading. And so what I want to do is I want to come in and just talk about what we got our setups here, and this is just, we pretty much do the same thing every time we come, right? So you guys who have been here a lot, you know that what we're looking at is we're looking at a chart. This is the NASDAQ. We're out in the futures market. We like to day trade in the futures market because we don't have any pattern day trading rules. And so we don't have to have $25,000. We can trade with a smaller account, and that makes it easy for us to get started. All right. We also have micro accounts. We also have mini accounts. What we're looking at right now is a micro account. So a micro account means from this very low to this very high, just to let you know the size of that move, that was $118. All right, $118. You're like, well, okay, 118 bucks. How much did I have to put in to make that $118 in that move? Well, that would have been about $100, $125. You can look at the key right here and it'll tell you. So it says the margin amount, day margin, 169 bucks. So to make that $118, and that's, you know, in 237 ticks, and we're on a 1 minute chart, so 230 to 60. So you can say 60, 120, what, about 3 or 4 hours, a little less than 4 hours. You'd have made $118 on 169. We have 60 ticks, 120 ticks. So 230 be another, yeah, about 2.5 hours, 3 hours. You'd have made from top to bottom, $118 on a $169 investment. Now that's a micro account. So that's a little account, small account, just to get started. You can open that account up with $2,000 and get started. Now you have to have special software to trade the futures market. You can't use the software that you use to trade the stock market. You need to have special software. Now there is some software that'll do both. You know, there's some guys that are out there trying to do both with the same piece of software. I wouldn't recommend that. That's like sticking peanut butter in your chocolate. It might taste good, but I think it's going to give you more heartaches than than you would like. You want a piece of software that's designed specifically for the futures market, to trade the futures market. And you don't want to be trying to use a stock software to trade the futures market. That's just not a good idea. All right, because they're totally different animals. They're similar in many respects, yes, of course, but they are different animals. I mean, you have contracts that expire in the futures market. You know, charts will expire. This chart right here, this NASDAQ 100 will expire, and you have to roll over and get a different chart. That doesn't happen in the stock market. So that alone is going to be a very confusing event that occurs, and you're going to have this software that, why do some contracts expire and some don't? I don't get it. And it's just going to screw everything up. All right. So just don't do it. Just don't do it. Just, if you're going to trade futures, get you a future software and learn futures. Don't think you can learn stocks and come over and start trading futures. It's a different world. You got to have different rules, lots of different things. Now there's a lot of the same. You buy low, sell high, you make money. That's pretty standard. But the rules of some of even the orders can be a little bit different. So we want to make sure that we're working with a tool that's designed, you know, get the right tool for the right job. Don't go out there and work on your Ferrari with a pair of pliers. It's probably not a very good idea. All right. So if you're going to do it, just, all I'm trying to tell you, you can lose more money in this market than you can shake a stick at in a very short amount of time. So just get the right tools, and that'll help you keep from losing money. All right. I mean, if you're going to do it, you might as well do it right. Okay. Take it seriously. That's all I have to say about that. But the software I use is this one right here.
Okay, this is the software I use. It's called Track and Trade. They've got 2 versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, so what we're doing is we're going to be working with a software called Track and Trade so that we can come in here and trade the futures market. Now, if you're using a different program, obviously the rules for the market are going to be the same, and you can probably get a lot of cross feed between the different settings, but you're going to see Track and Trade is designed to specifically trade the futures market using drag and drop orders. So we can drag and drop orders right on the screen. We trade right on the screen. We don't have to type in all these little order entry tools and stuff. When you're day trading, you don't want to have to do that. You don't want to have one of those tools, one of those programs where you have to actually type in, I want to buy quantity 10 of, let's see, the symbol is MNQZ25, and I want a limit order and a stop order, and the stop order needs to be at 2468675, and you type all that stuff in. By the time you do that, the market's gone. You've lost your shorts. So you can't do that. You got to trade with something that you can, that's very fast and efficient. And I'm going to show you right now. Let's see. We think the market's going up. We hit the buy market, and that gets you in, but now you can put some stop orders in there. You can move these things around. See how you just drop them on the screen? And if I want them to trail, I can right click on it and say I want it to, got to right click on it. So I can say edit, and it brings up that little screen, but then you just tell it right here real quick, I want to trail on the ATR, which is that yellow dot, and just hit OK, and it just trails. Now it's going to start following up automatically. So you do have to have a little pop-up to tell it, give it instructions if you want it to, but if you want to just hit exit chart, you're out. But now you got these little orders that drop on the screen. See how you can move them above? It's green, that means it's a buy. Below, it means it's a sell. So you don't have to actually type in anything. You can just drop it right on the screen. Now, if the market breaks higher and continues higher, that'll buy and get you in on a break above the previous green highs right there. You can do the same thing to the downside. You can come down here and drop a stop order down there. You can say, well, if it keeps falling and breaks below that area of support, that's why the line goes all the way across the whole screen. So you can line it up with areas of support and resistance, the historical areas of support and resistance. Those of you who trade, you know how important that is. All right. And then we have laid over the top of this chart, we have we have the Heiken Ashi bars. Now these are general candlesticks. So if I click on the candlesticks, you can see, if I can turn that off, this is what most traders look at. All right. This is what most charts look like. And it's a little bit more difficult to trade like this. I think it is anyway. A lot of guys don't like the Heiken Ashi bars, but I do. I like them. To me, I think they're kind of like cheat codes. All right. So I like to turn them on. And what they do is they kind of highlight the trend for you a little bit better. And you can see where the market's trending. Now, if the market's not trending, I don't care who you are. It's extremely difficult to make money, because what you're trying to do is you're trying to capture a little bit of a move in the market, right? From entry to exit. And it's always from entry to exit. So you can get in entry on where you get in. And we don't generally get in, right, at the exact tops and bottoms. We get in on these break points here. So we get in right here, and we'll get out like right there. Okay, the little yellow dots, if we're going to follow those little yellow dots, those little green trends. So that's what we're looking for, but we want longer ones. These are not very long. And usually the reason we like to come and look at power hour, because power hour is a little bit more aggressive, a little bit more likely to make money. So market has a tendency to trend farther. And that's what we're really looking for. We're looking for some aggressive markets that'll trend a little bit farther, and then we can get in on these different breaks. Now, there's lots of ways to read a chart. We're looking for little patterns, right? And what we're looking for, and I'll just give you a little example right here, is markets have a tendency to move in waves. Now we have trends. So an uptrend is higher highs and higher lows. All right, that's an uptrend. And we have a downtrend, which is just the opposite. It would be lower highs and lower lows. Now, we can have higher highs and higher lows and lower highs and lower lows in multiple ways. So we can come in here and look, and you can say, okay, I understand that. Higher highs, higher lows makes an uptrend. Lower highs and lower lows makes a downtrend. Okay, well, if we come and apply that to the current market, and we come in here and we say, okay, well, Lan, I can see your higher highs. Here's a low. Here's a high. Here's a higher low. Here's a high. Here's a little high in here. Here's a lower high. A higher high, and then a lower high, and now we're making lower, and now we reverse. We're coming back down. Now we're going the other way. So we're going lower highs and lower lows. So we kind of reversed, and in that process, the market makes all these little patterns. Okay, what we call reoccurring price patterns, and you'll see these all over the internet. People talking about them, and that's where this is. It's all based on higher highs and higher lows. So this is what we call a reversal pattern, where we have what we call a head and shoulders. So this little higher high here and this little lower high becomes the left shoulder. This one becomes the head. This one becomes the neckline right across here. This is the head. And then you anticipate a reversal in price. You anticipate lower highs. Now this made lower lows and lower highs, but now it's turning around trying to go back up again. So we'll see if it holds. But the idea is to anticipate the direction of the market movement based on these reoccurring price patterns. And it's all based on higher highs and higher lows. Now, you can also have higher highs and higher lows in the individual price bars themselves. So if we take just this little section right here, you can see that we have higher lows. See each one of these price bars? The low is higher than the previous bar. The low is higher than the previous bar. The low is higher than the previous bar. So that's an uptrend, right? In an overall longer term uptrend. So the overall longer term trend is up, right? Because we have higher highs and higher lows in the overall longer term. But this is the trend itself. So what we call this is we call this the counter trend, and we call this the trend. So we oftentimes you'll hear us say the trend is your friend until it bends or ends, right? The trend is your friend. Okay, so this is your trend. This is the trend. And this right here, these are the counter trends. These are the counter trends. Now, counter trends are oftentimes a lot shorter, smaller than the trends. So you don't want to trade the counter trends. You want to get out, or you want to stay in for the overall longer term trend, which you can do that too. You can say, well, I'm going to get in at the bottom of the trend down here, and I'm going to stay in until the top of the trend up here. The problem is knowing where that occurs. All right. How do you know that's the top, and why are you going to get out? Well, I can look back in time and see it. Well, when you're trading in real money, you don't have hindsight. All right. So saying that is easier said than done. So what we generally do is we do a little bit shorter term. That's why we call it day trading, is because we're going to come in here and we're going to try and capture these little green moves in the market. Or if the market's in a downtrend, it'll be just the opposite, right? The red bars would be longer and the green bars would be the short ones. So you can come back a little bit of time and you can see that the green bars, this one here, we had some nice moves. So that was a nice move there. This is a shorter move. This is a nice long move. And then it reversed, went the other way. And then the red bars were the long ones and the little green ones were the short ones. So that means that we have a downtrend, and then the green bars become the counter trend. So the trend and the counter trend, but that's a downtrend, bear trend, right? So this is a green trend, so it's bull trend. This is a counter trend right here. It's red, and then we get another trend. So we're getting higher highs on the market itself, like this, right? Higher highs, like that. And then, of course, it reversed and started to come back down, and we're starting to get lower highs and lower lows. And then in the downtrend, the little green bars are the small ones. So we wanted to capture the trend. Now, in the futures market, we can do something really cool. It doesn't care if you you can make money on the going down just as easy as you can going up. Now, of course, you can do that over in the stock market too, but generally in the stock market, you have to do something where you have to borrow the shares, you have to pay interest on the shares. If they're paying dividends while you have the shares, you have to pay the dividends. There's all kinds of caveats to doing that. In the futures market, there's not. There's no caveat. They don't care. You can buy it, and the way you make money is buy low, sell high, but you can sell high first and buy back low later. I know it's a crazy concept, but they let you sell something you don't own. That's why they call it the futures market, because you don't have to offset it. You don't have to make delivery till sometime in the future. And think about this as a product that you're buying and selling. Now, this is the NASDAQ, but think about corn, for example. If you buy corn, well, that would mean that someday in the future, you're going to take delivery of that corn, unless you sell it before you buy it. If you buy it, you can sell it before you have to make delivery. That's why it's called the futures market. If you buy it, you don't have to take delivery until sometime in the future. Now, this one here is set as the December contract. You see up there in the left-hand corner, it says December right there. So the December contract is when you have to take delivery of your corn, or in this case, NASDAQ 100. It says, I'm going to buy it, but you're not really going to buy it today. You're just putting your order in for it today. You don't have to take delivery of it until December. That's why I say the contracts expire. Doesn't happen in the stock market. Over here it does, because you're not trading the market itself. This is a derivative, right? So you're going to make a future purchase, and that's what you're telling them here. You say, well, I'm going to put up a performance bond of about 10%, which is why we can trade with a much smaller amount over here. And I'm not going to take delivery of my NASDAQ until December. And that's when I will pay the full amount. So I'm going to put up a small amount, what we call margin. Okay, you're going to put up 10%, and then you're going to pay the rest. If the 10%, let's say it's $100, that means in December you'd have to pay $1,000 to get take delivery of your NASDAQ 100. But in the meantime, you put up your 10%. You bought it at 24,685 right here. You bought it right here. Well, that means you get to make the profit from saying that you're going to take delivery of it sometime in the future. So you get to make as much money as it makes in between now and then, or loses, because it can lose money too between now and December. But you don't have to hold it all the way to December. You can hold it for 10 minutes if you want to. You can hold it for 30 seconds. You can hold it for 1 second if you want to. And then you just liquidate it and say, well, I decided I don't want to take delivery of it in December. And then you're going to make or break the amount of money as if you owned the entire contract, as if you had bought the full $1,000. That's why it's so cool. All right. That's why over here in the futures market, I oftentimes say you can make a lot of money with a small investment, because you're not really, the small investment you're putting in is not the full amount that you'd have to buy like you would over in the stock market. Stock market, you have to have a large amount of money to make a small profit, because you have to put up the entire amount of money to buy the entire thing. Over here, you don't. You just put up a performance bond and then promise that you're going to put up the rest of the money in December. But you're going to make the same amount of money as if you put up the whole thing. So that's what's cool about it. I know it's a little bit of a hard concept and a little bit different rules, but you don't really have to worry about that much, because we're not going to ever take delivery. All right. We're not going to ever worry about that side of the market. You just want to always make sure you're out before December. Okay. And when we're day trading, we're going to be out in the next few minutes anyway. We may stay in here an hour at the most. When you're day trading in the futures market like this, if you're in a position for an hour, that thing's got mold on it. It's getting really old and moldy. Okay. An hour long trade in the futures market is moldy. All right. So usually what we're doing is we're just going after very small trades. We're going after these little green moves. Why? Because that can be a lot of money. So if you get in right here at the bottom and you get out right here at the top, right there, you can't get it. Don't generally smart enough to get out here, and you're not generally smart enough to get in here. So this is what we call the profit box. So this is the trend box. If you go from the very top right here, the trend box is here from top to bottom, right? That's the trend. Well, you can't generally capitalize on that. You're not generally smart enough to get the very top and the very bottom. So all we can really do is we can get in right in here. And I like to use these little dots in here because they're real helpful. And I like to do, when I cross those little dots right there, that's where I like to get in. So if we can get in right there and we can get out right here where it crosses the dots, or see, in this case, the market turned red. Now you have to decide, well, it turned red, I'm going to get out. Or you can say, well, I'm going to wait for it to hit the little yellow dots, which would have been over here. So that's kind of your choice where you want to get out. You could try to get out up here, but up here might be right here. You get out and it keeps going up. So generally we wait for it to drop back down and get out when it crosses the little yellow dots. So that's the way that works. And so that ends up being the distance between where you get in right here and where you get out right there. Now in this case, that was $53 on a $100 investment. That's over 50% return on your money. All right. If you use 10 of those, you'd have $530 on a $5,000 investment. All right. That's pretty cool, right? Or $530 on a $5,000 investment. So, but this is on a micro. Now, if you come over here and look in our chart window, you see down here, I got minis. See this? This is a micro, this is a mini. Let's make this a little bit bigger for you. I'm going to drop me down here. So this, see over here, it says this little, I don't know if you can see it right there. It says micro. That's this chart. If we come down here to the mini, it's the exact same chart. Still notice it's a NASDAQ 100. This is the NASDAQ 100. This is the December contract. This is the December contract. The only difference is I'm looking at the micro here versus the mini. If I come over to the mini and go to the 1 minute chart, you'll notice it looks exactly the same. You can get your scaling about the same. So you can see it's about the same. We'll go there. Let's get rid of all the drawings. Let's see if we can make this line right up. We go here, and then we go 1 minute here. That's a little bit different. Let's see if we can get the scaling in there. And then here. You can see, though, it's the same chart. It's just a little bit different scaling. This is a little bit larger scale. Let's go down a couple points. But you get the point. It's the same chart. There we go. It's the exact same chart between micro and mini. The only difference is the leverage that you get. So now we go to the mini. Now when you get into one of these little charts, let's say from right here, you get in right here and you get out right here. How much is that? Different leverage. So you get in here and you get out there. That's $200. That's $300. See, if we were over on the micro, that move would have been $30. Yes, Lan, it's $300, but how much money would you have to put up to make that $300? Well, come over to your key and look, and it'll tell you day margin, $1,936. So you'd have to have $2,000 in your investment account and put that in here to make $300 in, and these are the 1 minute chart. So that's 1, 2, 3, 4, 5, 6, 7, 8 minutes. So in 8 minutes, you could make $300 on a $2,000 investment. That's crazy money. That's crazy. That's ridiculous money. That's ridiculous. Okay? To make that kind of money with a $2,000 investment. Well, Lan, I've got $10,000 I could put in this thing. Well, okay. You want to put 10 grand in there? Well, you just come in here with your little calculator and you say, you come over here and you go into your little preferences and you say, I got 10 of these things. Well, 10 grand, and it's 2,000. So you could have 5 of them, right? So we're going to put in 5 of them. Actually, we got to do it like this. 5 of them. All right. So 5 of them, you'd have made $1,450 in 8 minutes. That's crazy money with a $10,000 investment. That's crazy, ridiculous money. All right. Ridiculous, which is why you don't have to be that aggressive over here. You're going to make a lot of money with being very careful. All right. You can be very careful and still make a lot of money. Okay. So you don't have to have $1 million account to make that kind of money like those guys over in the stock market do. Over here in the futures market, you got the leverage, then you can do it either up and down because they don't care. If you got in right here, then from this side to this side down to where that's at, that's $150 right there on one contract, $2,000. Right? $150 on a $2,000 investment in 1, 2, 3, 4, 5 minutes. So that's why I'm saying you don't have to be aggressive. You don't have to be crazy. You don't have to stay in the market forever to make a lot of money. You can trade these little tiny moves in the market. That's why you sit on your hands mostly when you're trading like this. You're not in the market all the time. You're only in the market. You might sit here for an hour and only be in the market for 5 minutes during that hour's period of time. But that one little period of time that you've been waiting for to get just your right little setup and make sure the market's moving and trending and moving a little bit and shaking, that's where you make your money. You don't make your money from trading. You make your money from not trading, but being very strategic and very surgical about your entry and your exit. All right. A lot of people think when you're day trading, you're always, I'm getting in, I'm getting out, getting in, getting out. Oh, I'm in. I've been trading for 8 hours. I'm so tired. I'm getting in and out. No. When you day trade, mostly what you do is you sit back with a bag of potato chips and hopefully you're eating, maybe apple chips instead. Don't eat too many potato chips. Then you end up, like me with a heart attack. So you come in here and you just wait a lot. You do a lot of waiting and you wait till the market starts to move. And when it starts to move, that's your signal. Then you're like, hey, wait a second. Something's going on. Market's moving. Look at that. It's moving. All right. Oh, I might want to trade this. And then you come in with your orders and you might wait for 2 hours sitting here waiting. That's your job. That's your job. Your job is to sit here and wait. And wait until the market does something that's going to make you some money. And if you overtrade, that's where most people lose money. They sit here and overtrade. Now, we do a lot of overtrading here in the class because we're exempling how to do it, right? We're learning. But when you are trading, if I was really trading this market with real money, we might sit here for the whole hour class and not place a single trade because the market's not doing anything that's making us want to get into the market or believe that there's an opportunity to make money. You can make so much money with this market if you're careful, but you can lose so much money if you're not careful. That's the problem. All right. So you want to wait until the market's really making some moves. Right now, it's not. This is not a good market to trade. Look at that. Lots of topping tails, lots of bottoming tails, very smooth, very few moves on the trend. The market's dead. Nobody's moving. Nobody's trading. So there's really no reason for us to get in and take a big risk. And you're like, but Lan, I need to make money today. No, you don't. That's the first thing that'll make you lose money. Yeah, you don't need to lose money today either. All right. So what you do is you have to sit here and wait. And you have to wait and wait. And usually I like to wait for certain times of the day. If I'm going to come and day trade, I like to trade at the tops of the hours. What you're going to find is that starting usually sometimes about 5 minutes, maybe 10 minutes before the top of the hour, people they like to trade tops of the hours. All right. And you want to trade. This is a Me Too market. When everybody else is trading, that's when you want to trade because that's what moves the market. That's what makes it go through trends. That's what makes these trends like this. Okay. And that looks like a good trend. It's not really that great of a trend. You'd like to have that be longer even. Okay. you can slide back here in time. You can see where some better trends are. Now, this was pretty good. All right. This was pretty good. We could have traded. We could make money there. We could make money here. We could make money on this one here. This was nice. These were nice moves. But then it died. Look, it died right there. Okay. So it started down here at 11 o'clock. Like I said, top of the hour. And it traded. That whole hour was really good. And then this hour started at noon. Everybody went to lunch. Nobody wants to trade during lunch. And then 1 o'clock comes along. Everybody starts coming back from lunch, getting in here at 1 o'clock. That's everybody got back from lunch at 1 o'clock. Now we're going into power hour, the last hour of the day. Usually we get a little bit of move out of here. I know it's something we can trade, but for today it's not being very active. So the hour before lunch, and you can see that. Oh, look at this. This is this morning's trading session. So that's why a lot of people like to trade in the morning, because most people come in and they want to trade in the morning. That's a big move. Look at that. That's beautiful, right? From here to here, just from arrow to arrow, that was a $2,915 move on a single contract, $2,000. That was 100% return on your money. Actually, more than 100%, 150% return on your money in 583 ticks. 583 divided by 60 is what? You could probably do the math in your head on that one. 583 divided by 60. That was, no, that's not right. That's 60 ticks. 900, what did I say? 580, not 900. Land. 583 ticks divided by 60 ticks. Yeah, it says it's 90 minutes. Is that right? I'm not. 583 minutes. Oh, I did that math wrong. That's what's wrong. 583 divided by 60. Okay. Yeah. Is that 10 minutes? That's a 10-minute time frame. That market was really moving. So it went from 9:30 to 9:13. Oh, 10:30. Oh, 45 minutes. 583. Oh, that was ticks, not bars. Oh, sorry. I was thinking that was price bars. 583 price bars. Why didn't I recognize that in the first place? That's ticks. Sorry, not price bars. So this was our price bar calculator. I was looking at the wrong calculator. Here we go. There you go. That makes more sense. It tells you right there, 45 minutes. 46 ticks. 45 minutes. So it's 1 minute ticks. There you go. So anyway, that was a $2,915 move with a $2,000 investment. Do you get your $2,000 back? Yeah, of course you get your $2,000 back plus your $2,900. So you get your $2,000 back plus your $2,915. All right, that's how it works. Now, if you want to, you can. That's taking a short position. All right, that's taking a short position. So there's no penalty for that. There's no dividends. There's no interest. You can just do it. And you sell first. What you do is you sell first and you buy back here and you make the difference between where you bought and where you sold, right? Buy low, sell high. It's the only way you make money, but you can sell high first. You sell here and you buy here. So you bought low and you sold high and you made money. You just sold high first. They just let you do it. You're like, oh, man, I don't understand that. How do you sell high? How do you sell before you buy? I don't own it. They don't make you own it. You don't have to. It's just the rules. All right. You just have to make sure you do all this. You have to sell it and buy it. Whether you buy it first or sell it first or buy it first, you just have to do both. And you have to do it before December. Before December? Well, that's 3 months away. Yeah, there's no pressure other than when the trend stops. All right. Now, the problem with this type of trading is that these markets can move a long ways and make a lot of money or lose a lot of money. So what happens is a lot of people will come in and they'll get into the market. They'll say, okay, I'm going to get in right here. And the market starts to go in their favor and they're making a little bit of money. And then it turns and it starts to fall and they don't get out. And they say, well, I'll just hang on to it. I'll just hang on to it until it comes back. Right? I'll just hang on to it till it comes back. But what if it doesn't come back? How long are you willing to hang on to it? This thing can lose a lot of money and it can go down a lot longer than you can stay liquid. All right. Market can stay irrational longer than you can stay liquid. If it just went down to that little distance, that'd have been a $2,300 loss. Well, I'm going to wait for it to come back. How long are you going to let it go? Because it might not come back. It might just keep going and going and going and going and going, and they're just down here to $5,000 loss. That's how people lose a lot of money in these markets. So what's the key? The key is this. It's very simple. Let's keep it very simple. Now, you can make it more complicated if you want to, but the key is to keep it simple. The idea is to identify whether the market's making higher highs and higher lows or lower highs and lower lows. Does it have long green trends and short red trends? If it is, it's in an uptrend. Is it making long red trends and short green trends? If it is, it's in a downtrend. So we want to trade the trend. The trend is your friend till it bends or ends, right? So we want to trade. If we're getting long greens and short reds, we want to only take longs. We only want to go long. If we're getting long reds and short greens, we only want to take reds. And once we get in, if we're wrong, if it doesn't immediately go in your favor and start making you money, then get right back out. That's the key. If it does not immediately start making you money within 1 to 2 bars, you just get right back out. All right. All right. So that's what we're going to do. So I like to use these little arrows. Now, these little arrows are called the ATR, average true range. Now, I like to have these average true range. Now, you can move the stop factor, and the stop factor is just how far back the little yellow dot is from your market. You make it more, you put your stop a long ways back. That's a long ways to have your stop to get you out if you're wrong. That's a $1,300 move. I don't know if I want to have it back that far. Okay, well, then don't put it back that far. So come back in here and make this a little bit smaller and bring that dot closer, 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 closer. How close you want it? You can bring it pretty close. You start getting it too close, then it starts doing this kind of stuff. So it's kind of a happy medium. You have to kind of tune it in. Some of you guys are old enough to remember the old radios that we had in our old Ford 150s. Remember those old radios? You had to dial them in. And you dial it into it. And then you get into the radio and you can listen to some music. Well, that's the way these indicators are. There's no right setting. All right. It's like, well, what's the right setting, Land? There is no right setting. The right setting is what is the market doing and where do you want to put your little yellow dots? How big is your risk? How much do you want to move out? Now, I like to have ATR start with 1 up here on the top. That's my right setting. And then the stop factor, I'll make it go up and down based on whether the market's more aggressive or less aggressive. If it's less aggressive, you have to pull your stops back a little further. Of course, you're taking a bigger risk. That's why I like to have them down here pretty tight so that I'm trading a pretty tight market. I like to trade more aggressive markets that are trending better. If the markets, if I've got this set to 6 or 7 or 8 in here and this is too far away or too close, then I don't want to trade that market. That's kind of a little indicator for me. 6 is kind of my happy medium. I like to be right in there at 6. See how that's really nice on these trends, but see how it's too close right in here? So if it's too close and you're on 6, well, that means you shouldn't be trading. That's a flat, dead market. But this is a good time to be trading right in here and see the little dots are a long ways away. You're like, well, Land, how do you know when it's going to do that? Well, sometimes you have to just wait. Oh, it made a nice trend. So now it's making a red trend, the counter trend. Now we'll wait and get the next one up. That's called the ABCD pattern. All right, ABCD pattern, ABCD. Oftentimes we'll miss A to B. We don't get that one because it takes off and runs without us because it was coming through a sideways market. We don't know when it's going to take off and go. And then suddenly it does. And then it gets a little pullback here. And then that's where we get in. We're like, okay, well, I'll take the next one and see if I can't get higher highs and higher lows. I'll take that next one up. And that's the one you're going to make money on. You go from here to here. Maybe you'll make $500 and you'll be done for the day. All right. Our goal is make $500 a day. Now, some of you say, I want a bigger goal than that. Okay, well, when you're a better trader, you can have a bigger goal. But in the beginning, let's start with just trying to make $500. Okay. So we're going to sit on our hands all day long to make $500. Now, you can go out and work at McDonald's or, somewhere. Can you make $500 working at McDonald's in a day? Probably not. So you can sit here for 8 hours just to make $500, and you're still making a lot of money. All right. And then you can get good at it. You can do 2 contracts, make $1,000 a day. Not a lot of jobs you can go to and sit there for, 8 hours and do nothing but drink lemon water and eat apple chips and then see the right move, stick 2 contracts in there and make $1,000. But if you go in there and you're wrong and you just jumping in and out all the time, you're going to lose $1,000. You're going to make somebody else very happy on the other side who's taking your position on the other side. All right. Right now, the market's dead. You can't make any money doing this. You got to wait for the market to trend. So technically speaking, we shouldn't be trading. But here's a nice way. I'll show you some neat little tricks. What I like to do is I like to come in and use these little dots. Now, you saw me earlier. Track and trade will actually trail automatically move for you. Now, there's a lot of things track and trade will do. I can't show them all to you in one class, but I can show you the most important things. Now, you can program these little buttons down here to do this stuff, but we're going to do it manually right now just so you can get started. But see these little yellow dots? See, there's one just flipped to the other side. So the market's coming down. So we got a little short downtrend, a little small uptrend. Now we're going to go for the next downtrend, the ABCD pattern, right? But if we're looking for a reversal, we might look for and trail on the little counter trends like that right there. That's where we'd like to get in, right? So we could just hit market order and get in, but I want to show you this intercept order. It's called an intercept order. So we're going to intercept. I'm going to show you how to do it. Now, of course, we're going to do this a reversal, and I wouldn't recommend you start off trying to catch reversals. Reversals are really hard to catch. It's easier to catch the trend. So what we're going to do is we're going to wait until the market is moving through the trend. In this case, it's red, small trend, counter trend, and then we're going to catch the next leg. So right in here, when we go into the green bars, we're going to try and capture the next down leg. So what we do, but I can't do it right here because we're already in it. So I'm going to do it on this dot right here. We're going to come in here and we're going to drop this in here. And you can just drop it way up here anywhere in the black zone. And you can right click on it and say edit. And you can say trail. And this first section up here is this order control. And you just say ATR stop and you hit OK. And it's going to move all by itself. Now notice that the little triangle is open. It's not closed. It's not a color. It's black. You can see right through it. So that means that you got down here, you got an active order that's sitting in here, and this active order is sitting there, and it's going to move down with the little yellow dots. So it's going to be what we call an intercept order. So as that market turns around, starts to go the other way, it's going to cross over that little yellow dot. So that's what makes it determine how close you want those dots. How far do you want that market to have to turn around and go back before it hits those yellow dots? You can suck them in, make them a little closer. You can push them out, make it a little farther, a little bit more confirmation, one or the other. Kirk says he likes 8.0, so that's a good one. I like 8.0, but that's a little bit for a market that's a little bit less aggressive. I like 6 when the market's really pumping and doing well and going aggressively. So 6 and 8, and I like 1 to 1. So sometimes we'll use on a little bit longer trend, we'll go to 1 to 1. All right, that's our indication. We've got 15 minutes till the market closes. All right, so you can see the market's moving down. Now, if we'd have done our little intercept order, we see where the market started to move down, and then we got a little counter trend in here. If we'd have put our order on that little dot right there, see, if we'd have put an order on that little dot, we'd have got filled right here to the short side with a sell order. And the market would be up right now from this little yellow dot to where the market's currently trading. We'd be up $230. But we didn't catch that one. So we're going to, in this case, we're going to be catching with this little yellow dot coming down. We're going to be catching a reversal. All right. So the market come down. And then in this case, we'd want it to turn and go back up really far. But that's generally not what you want to try to anticipate. The market's in a downtrend. Generally, it's like a market in motion will stay in motion. So what that direction is the direction you can generally anticipate the market continuing to. So Kirk likes 8.0. That's a good one. I like that one too, Kirk. But sometimes I'll get a little bit more aggressive, go down to 6. Sometimes I get a little bit less aggressive. I go up to 1. So 1 to 1 or 1 to 6 or 1 to 8. Those are all good numbers. I like 1 to 7 because 1 to 7 is kind of a little bit tighter than 8, but it's not quite 6. It's kind of halfway in between. So all those numbers down there are good. This just depends on what the market's doing. So like I said, which channel are you going to tune it into? So at this point, what we're doing is we're just having it trail down. Notice that it's automatically moving that little order down on those dots. And when the market turns around, starts to go the other direction, it'll be there to intercept, and it'll fill the order and will be long the market. We're going to buy 1. So at this point, we just let it go. And that's trading. Now all we have to do is sit back. And the computer's going to do everything for us at this point. Oh, we just got filled. Now we're filled on the counter trend. So technically speaking, we wouldn't really, unless we get a reversal, which is less likely, not saying it's not likely, but it's less likely that we're going to get a reversal. we could right here get a reversal. We got two downs, A, B, C, D, and sometimes it's at that A, B, C, D that we get the reversal and starts going back up, right? Sometimes we'll get a third drive, A, B, C, D, E, F. Okay, and then we really expect it to go back up. But this is kind of the 50%. This is what we call a two-drive pattern or an ABC pattern, right? So we're on the kind of the midpoint, the B point, A, B, C, D. So A, B, C, D, E, F. So you have the three drives. This is the end of the second drive. So you're kind of the halfway point. Those numbers are called Fibonacci numbers, but that's a little bit beyond the scope of today's class. But see how we intercepted and we caught that? We're now up 120 bucks. All right, on a single contract here in 30 seconds, 1 minute. Okay, so now what we want to do is we want to use the other dots as our stops to get us out. So you can come in here and you can say stop and you drop that in there. Anywhere down here in the black spot's fine because it's going to move to the right spot for you. So you just right click on it and say edit. And you want to say, I want to trail that on the ATR and hit OK. And there it goes. Now it's going to trail up and it's going to follow up as long as it wants. Now you're up to $200. You can say, oh, I just want to take it off at $200. $200 is good for me. I'm happy. I'll take my $200 and run away. You could do that right now. That's a nice little blast off up there, but it might go farther. And you've only got one contract, so you can't say, I want to take half of it. You can't. You've only got one. If you had two, you could take one off, let the other one run, but you've only got one. So you can't go in and say, oh, I want to take half of it off. You just have to, one's the smallest number you can use. That's a nice little intercept that we got there. We're up $255 right now. Do you want to take it? Yeah, you can take it. But if you trail up with your stop, now your stop's basically at break even at this point. All right. So it's at break even. Now, if the market goes really far, you make a lot of money. If it turns around and comes back and stops you out, you get stopped out and you lose your entire $195. You get stopped out at break even and you don't make anything. So that's why you want the market to be making nice, big, beautiful, sweeping trends. And some days you might not get any trades at all. You might sit here all day long and not find a market that's moving and shaking for you. And so you don't trade at all. You sit here for 8 hours and make nothing. But the next day you'll come in and you'll set off one of these and you'll make 3, 4, 5 grand in one day. And that's okay. There's nothing wrong with that. Nothing wrong with making 3 or 4 grand in one day and nothing the next. That's probably a better way to trade because you're not being aggressive and over trading and trying to catch every single tiny little move. Once you get good at it, you can get good at it and, do what you want. Now we're approaching $400 right here. If it hit $500, that's your goal for the day. You could take it off. Now I'll show you another little trick. We can come in here and we can go delete. I'm going to delete this trailing stop on the yellow dot. And I'm going to right click on the order itself. I'm going to hit add OCO. Now you'll notice that in this case, I have these 2 orders that dropped in. One went off the screen. I'm going to bring it down here. But this one up here is a target order where you can take your profits off. And it tells you how much you'll make right here. If it goes up and hits that blue line, it's going to hit $1,000. So we can bring that down and say, well, my goal is 500. You just put that in there at 500. And it says, if it hits that, well, I'll just take it off. It looks like it would have hit it if I'd have had it down there sooner. We'd have hit $500. Now this one here, I'm going to go in here and hit edit, and I'm going to come down here. Now we're dealing with what we call OCO, so we have to look at this little box down here. And we want this one again to trail on the ATR. We say okay. Now we're still trailing, but we have our target out there at 500. So if it hits 500, which is our daily goal, we'll take it off and be done for the day and walk away. All right, it would have hit it. That 500 was right there. It went right from our entry point to $500 was right there. It would have hit it and we'd have had our $500 if we'd have put that in the first place. Right now, we're just having our trailing stop. It's going to go up, and we still got our target up there. We put that in at 500. So if it goes back up there and touches it, we'll have our 500 and we'll be done. Come on, baby. Touch it. It's like candy. Come on. It's like cheese for a mouse on the mousetrap. Come on. Now, this is called the squeeze trade. What we're doing is we're squeezing the market between 2 orders that are going to get us out. This order will get us out, and it'll get us out with $500. This order will get us out, and if it comes down and touches that, it'll get us out with $160. So either way, we're going to make money. It's called a squeeze trade, right? We're squeezing it between 2 orders that's going to exit the position. It's just that one makes more money than the other. Okay, now it's going into what we call a little pennant formation. See how we have lower highs? So you have higher lows, the bottoms higher lows, higher lows, higher lows on the individual chart, individual bars, but then we have a lower high. So that's called a pennant formation. All right, little pennant formation comes in here like this, and you get a little pennant formation. Now, generally, it's considered a continuation formation. So it will generally break out the top of these things. Doesn't mean it has to. Oftentimes they break down the bottom and give you lower lows, and then it'll hit the reversal and will come down and stop us out with our $185 profit. It says this is sitting at 185 right now, right there, 185. Now we want it to break higher. We want it to break out the top and go up and give us our $500. But you can't make the market move, so all you can do is sit. Now, I have extra powers that you might not have. I can make markets move. Watch this. I have this little voodoo doll, and I can threaten him. And I can say, if the market doesn't go up, I'm going to stab you in the neck. And then he makes the market go up. That's how much power I have and authority to move these markets. I can move them with my voodoo doll. Maybe you might want to get a voodoo doll too, and you just threaten your little voodoo doll. You say, look, I'm going to stick this pin in your neck if you go down and hit my trailing stop. So you're threatening your little voodoo doll. That makes the market go up. All you have to do is just make him go up high enough to hit that $500, and then I won't stab you in the neck. But if it goes down and hits the trailing ATR, I'm going to stab you in the neck. See that? Look, works. It works. Look, it's going up. That's how much power he has. He's a very powerful little voodoo doll. Come on, buddy. Push it up there. I'm going to stab you in the neck. And it hurts. It hurts a lot to be stabbed in the neck. Oh, see that? I don't have to stab him in the neck. He made me the money. Nice job, buddy. Okay, so we just made $500. There we go. All because I have a voodoo doll. Now, if you want the market to go down, you have to have a red voodoo doll. All right, that's the red market. This one here, this little guy, he's the green market. He makes markets go up. This little guy, he makes markets go down. All right, so that's the power you have. Once you get into the market, all you can do is cheerlead or stab voodoo dolls to make the market move in the direction you want. All right, that's it. That's how you make money trading. We're up, well, $480 because we had a couple little small losers there in the beginning as we were exampling, but that's the nature of the beast. Now we can come in and we can automate some of that to make it a little easier with some of these buttons. So come back next week, next Wednesday, and I will example for you how we take that same concept, we automate it and make it so the computer will do not only trail for entry with the intercept order, but also automatically put the trailing stop and automatically put the limit order right where you want them. So all you have to do is click one button, drop it on the screen, sit back and eat your apple chips and drink your lemon water. And you don't have to do anything because it'll automatically set that thing at $500, automatically set your limit order or your stop order to trail up on the yellow dots for you. And all you have to do is just sit here and watch. But that's next week. All right. All right, we got 5 minutes till the market closes. I think that's close enough. We made our $500, $480. That's close enough. And I've taught you everything I can get you started on this. Now I want you to practice this throughout the week. Next week, again, I'm going to come in and show you how to automate it. All right, any of you guys have any quick questions before I let you go? Kirk says he prefers the not sure of NQ as it moves fast. It does. NQ can move a lot faster than S&P. S&P is a little bit slower, but and it's also, well, I was gonna say it's a little bit smaller too. It doesn't have as a big of, if you lose on the mini, it doesn't lose as much. But it's oftentimes because the trends are smaller, you don't lose as much. But the size of the market, the NQ is the biggest. And NQ is usually pretty aggressive. It's a pretty aggressive market, but we're looking at a 1 minute chart. We can go down to smaller things. Maybe Kurt is bringing up a point. We could go down to something smaller than a 1 minute chart. Now, I know 1 minute chart seems like the smallest point, but we have range bar charts, and you can go down to something really small like this. All right. This is a range bar 6. And if you go down to a range bar 6 on an active market, NQ, NASDAQ today this is dead. I mean, Kirk's right. Oftentimes this market will go all over the place. It'll just be going across the screen on these range bar 6s, and it just goes too fast. You can't trade it. But today it's so dead you could even trade it on a range bar 6 time frame. So range bar 6 just brings you down really small, and you can see that that's about 120 bucks on that move. So this move here from this entry to this exit would have been about 180 bucks. All right. So these are just, all it does is takes the 1 minute chart, the 1 minute bars, and breaks them up into smaller bars. So smaller time frames, less than a minute. Not necessarily, because range bars don't have time involved. So it just breaks them up into smaller increments. You can go to range bar 25, and that's a little bit more, kind of closer to what you might see with a 1 minute chart, but nonetheless, it kind of breaks them up too. Range bars is kind of a different animal, and we'll talk about that another time too. It doesn't have time involved. There's no time involved. It's just trend alone. But today we just traded the 1 minute chart, and sometimes I like to trade the 2 minute chart. 2 minute charts are a little bit smoother because you don't get the chop of the 1 minute chart. So that's a 2 minute chart. You can see it's dead, but we're going to turn on Fibonacci, and kind of you can still see it's pretty dead. Turn off that one there for now. But back here, look at that. Ooh, nice move. But that's a long move. See, 2 minute chart kind of smooths this stuff out, but that's why you might have to sit here for an hour or two and not make any money because it's not trending. But once it starts to move, you can say, hey, it's starting to move. I'm getting a little bit of movement in here. Maybe I want to do something with that. You come down to a smaller time frame if you want to. Come down to something like this, or come down to something like this. See that little range bar 6. I really like range bar 6. That's the one where we talk about that. It's called the Heisenberg strategy, where you come down to this range bar 6 and you trade these markets on these little tiny moves. But you got to be smart enough to move against these little red trends like this. And we can do that. It's called price bars back instead of on the ATR. And you can do that too. You can do the intercept order. Now, if it starts to move a little bit too fast, like Kirk says, might not want to trade it. Moves too fast. But NASDAQ today is not too fast. It's really quiet. A really quiet day. All right, guys, I want you to do me a favor, because I'm going to do you a favor. You do me a favor, I'll do you a favor. I'm going to write a magazine called Pit News Magazine, and I'm going to give you all this really cool information in it every month about trading. All you have to do me a favor, is go subscribe to it. All right. And it's only $39 a year, not a month, a year. And all the articles have recordings on them. So you can just listen to them like podcasts. Okay. And we're going to talk about all this really neat stuff in that magazine. And I do that for my classes, but I do charge $39 a year. It's what we were talking about earlier, where we have a community. And that's the closest thing I have to a community right now. There, the market just closed. So Pit News Magazine is my community. And the new issue, which is going to be coming out for October, is really cool. We got some really great articles in there I don't think you're going to want to miss. How do you get a copy of it? Let me just tell you real quick here how you can get a copy of it. All right.
Ready to level up your news game? Welcome to Pit News Magazine, where stories come alive. Read it, hear it, or watch it in our YouTube classroom. Right now, get your first 2 issues for just $1. Yep, only $1. Don't love it? Cancel anytime before the $39 yearly fee kicks in. Try it out, risk-free. Satisfaction guaranteed, or your money back. Visit pitnews.com. That's pitnews.com. Pit News Magazine. News your way.
All right, that's it, guys. And if you don't think that Pit News is great, well, here's somebody who does. Will tell you, this guy thinks Pit News is great.
Look, folks, I was reading this thing, Pit News, right? Great stuff. I mean, back in Scranton, we had newspapers, but I didn't have, the thing with the facts. Claire Christensen, she gets it. Sharp gal. Reminds me of my Aunt Margie. Could parallel park a Buick with one hand. Subscribe.
All right, subscribe to Pit News Magazine. You don't want to make the same mistake Joe Biden did.
Come on, folks. Look, the only thing I regret about my presidency is that I didn't subscribe to Pit News Magazine. Don't make the same mistake I made.
And of course,
look, if you haven't subscribed to Pit News Magazine yet, then I'm going to need to see you professionally, because you must have something wrong with your brain.
yeah, don't have something wrong with your brain. Go get Pit News Magazine, and we will see you guys tomorrow bright and early, 8 o'clock a.m., and we're going to go through our stock market portfolio. All right, we're going to take the $500 that we made here today. We're going to go put it into our stock market portfolio. Now, of course, today's money was demo money. stock market portfolio money tomorrow morning. That'll be real money. So come and look at my real money portfolio. I'll show you how we're doing. And 8 o'clock, bright and early, Mountain Standard Time, stock market portfolio in the morning. See you then. All right, take care.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.